I think there's kind of a technical definition of what carry is, and then there's the kind of colloquial definition. I think people people have heard of carry in the financial industry, maybe associate carry with a strategy that was fairly common in the early 2000s, the carry trade, which typically was constructed by borrowing in funding currencies with low interest rates like the yen, and in for a long time the US dollar, to invest in currencies with higher local interest rates, which often are emerging market currencies. Think the Brazilian real or the Mexican peso or what have you. Though it can also be in developed market currencies. It's just typically that the spreads are a little bit lower. But the idea is let's say you're borrowing at 2% to invest in a currency where the cash rates are 4%, and you're going to earn that 2% return as long as the price of the currency doesn't change against you, right? And so during pro-cyclical periods, which is kind of 80% of the time when markets are uh, risk-seeking, investors are deploying their capital, hoping for a return on investment, then those carry trades tend to be highly profitable. And historically, in the currency carry trade, kind of 10 to 20% of the time, when investors are more concerned with return of capital during risk-off periods, they tended to go against them. So the currency carry trade was often associated with having these fat negative tails, where most of the time you're doing really well, and then some of the time you give back a lot of the returns that you earned while you were doing well. And so, that's just one kind of narrow expression of a broader concept of carry. We like to think that carry, as a technical definition, is just the return that an investor expects to get on an investment if the price of that investment doesn't change, right? So if you buy an apartment building, you're going to rent out the apartments in that building. You're going to borrow from the bank in order to buy that apartment building, and you're going to collect rents. Presumably, the total sum of the rents is going to be higher than the interest that you need to pay the bank or the cost of capital on that investment. That difference is the carry on that apartment building. In a stock portfolio, the carry is the dividend yields that are paid out by the companies. So even if the the value of the stocks in the portfolio don't go up, then you're still earning this constant income from the dividends that are getting paid. This is perhaps most familiar for bond investors. Obviously you invest in a bond. Well, you can borrow cash to invest in bonds. Typically, bonds have a higher yield than cash, either because they've got credit risk or because you're looking to lend money for a longer horizon. Like cash, you can get your money back right away. You know exactly what the value is going to be. But if you lend your money out for 10 years, interest rates may change in the meantime, inflation may change in the meantime. And so typically you need to be compensated with a higher yield to lend money for 10 years than you would just to lend money overnight in the cash markets, right? So that is also a carry trade. And then there's also a carry investing in commodity futures. And it's a little more nuanced. That requires a little bit more explanation. But the idea here with the carry trade or carry strategy that we're big fans of is that we're not just investing in currencies and absorbing that kind of, you know, pro-cyclical risk. Rather, they're investing in a wide variety of different asset classes. And because those asset classes tend to have their best and worst returns in very different economic environments, they tend to balance each other out. And while it's far from a risk-free strategy, you do get an enormous amount of benefit from that cross-asset diversification. So you're picking up dividends, coupons, and convenience yield from commodities, and this positive carry yield differential from currencies, all in one broad portfolio. And they just, you're never all jumping on one section of the trampoline. Rather, you're, jumping at different times on different sections of the trampoline, and it's a much more comfortable ride. In order for markets to entice you to come out of cash where you know the value of that cash is going to be tomorrow. You can use it for consumption today. In order for the markets to entice you to, to invest your money in something risky where you don't know what the value is going to be tomorrow, where there is some price risk if you try to redeem before maturity, then typically the markets need to pay you a higher expected returns, right? Stocks pay you dividends, bonds pay you a coupon in excess of the cash rate. Um, Higher risk currencies, or currencies are experiencing higher inflation, or higher inflation risk will often have a higher interest rate, right? So investors need to be compensated for putting their money in those different areas, and that compensation is carry. The primary bet that we're making is that on average, investors would prefer to put their money in higher yielding equity markets than lower yielding equity markets, higher yielding bonds than lower yielding bonds on a risk adjusted basis, right? I mean, obviously, if a market is perceived to be much higher risk, then it needs to pay a higher return, and the risk adjusted expected return might be the same as a lower yielding market that has lower risk, right? So really what we're trying to do is emphasize markets that are getting paid more, or that are paying investors more for the same level of risk, and de-emphasizing markets that are paying investors less for the same level of risk. And importantly, sometimes markets actually are paying, are giving negative expected returns. So you can imagine from 2022 until some point in 2024, we had an inverted yield curve. So investors were actually willing to lend money for 10 years at lower rates than where the Fed was holding cash rates, right? So in that case, you're able to get better returns on cash. You're actually better to borrow at the 10-year rate and invest in cash. And so sometimes you want to be actually short bonds. Sometimes the dividend yield on equity markets are way below the dividend yield on 10-year treasuries or even on cash. And so you want to be short uh, equities and long cash, or long treasury bonds. And sometimes commodities have inverted curves as well, which means that you get paid for being short instead of being long, right? So this is a long short portfolio that really is just trying to position into markets to maximize the absolute level of risk adjusted carry, whether that carry is long or short. Let's call it an uncorrelated strategy, because sometimes people perceive absolute return as being very, very low risk. Like you kind of expect that the portfolio is just going to go up almost every month, right? Carry strategies depend, you can set them to any sort of risk target you want. The diversification does an enormous amount of work in order to manage that level of risk, but you still definitely get a ride, right? As you wait for markets to settle into and/or find equilibrium, moving towards markets that pay higher risk-adjusted carry. But markets move in the short term for a variety of different reasons, and investors are not always uh, only concerned with seeking the highest carry differential. Sometimes they're fleeing risks. Sometimes they're in high speculation mode, and they don't really care about what the yield is because they think there's going to be a buyer or buyers who come in soon after and continue to push prices even further away from equilibrium. There's a variety of different reasons that markets can dislocate from the direction that you'd expect if carry was the only thing that investors cared about all the time, but they don't, and therefore you absolutely do get these fluctuations. Investing in corporate bonds is a carry strategy. Investing in high yield bonds is a carry strategy. Investing in duration is a carry strategy. Investing in dividend stocks is a carry strategy, but they end up being these highly concentrated portfolio bets, right? So what we try to do is we say, well, we're going to use futures markets to invest in the global equity indices with the highest risk-adjusted yields, the global government bond markets with the highest risk-adjusted yields, the global currencies with the highest risk-adjusted yields, and the global commodities with the highest risk-adjusted yields in the direction that they are currently paying those yields. And as a result, because we're, sometimes we're long and short different equity indices, long and short different government bond indices, long and short different currencies, and long and short different commodities, it ends up having a diversified global carry strategy ends up having a very uncorrelated return stream relative to traditional allocations to equities or bonds that most investors would have in the portfolio. To answer your initial question about how accessible these strategies has traditionally been, well, the currency carry strategy was traditionally, an institutional only strategy, right? That, invested in by pension funds, by hedge funds. Eventually, many institutions brought that in-house. They made them a little bit more sophisticated. So to this day, many institutions do run large currency carry books. Many institutions, though probably a much smaller number, run diversified carry strategies. But it has traditionally been very difficult for retail investors or smaller investors to get access to the global carry style strategy. But they could get some exposure to it by investing in managed futures funds or managed futures indices. Typically, managed futures are known for their deploying trend following strategies. And it's still true to this day that the vast majority of the returns to managed futures are explained by trend following. But what we've observed in our own research, and there's been other studies that confirm this, is that over time, many managed future strategies have also begun to add in carry signals into their trend following strategies because carry is a really nice natural diversifier to trend. Trend typically tends to chase into the extremes of trends, and often at the extremes of trends, the carry gets quite negative. The market gets quite extended away from the natural kind of economic equilibrium. And so adding some carry to a trend strategy can do a nice job of balancing out the most extreme elements of trend. And in fact, if you look over the very long term, the diversified carry strategy and diversified trend strategy end up having a relatively low correlation in the neighborhood of kind of 0.3, zero 0.4. So there's just really nice complements for one another. As an example, if you are an American investor or Canadian investor and you invest in European stocks, and euro cash rates are substantially lower than Canadian cash rates. Well, you implicitly are expecting a negative carry on the currency even while you're investing in your European equities. That's often an unintended bet, right? If you own a carry strategy, then definitionally almost definitionally, there are some risk elements involved, but all things equal, that carry strategy would do some of the work in hedging the negative passive carry that that investor would have in owning those foreign stocks under that condition, because the carry strategy would naturally be short the euro and long the Canadian dollar, for example, in the example that I gave, right? So, it does sort of make explicit all of the bets in the portfolio and make sure that you are properly positioned to harvest carry in the right direction at the right time. You're making explicit many bets that were implicit, and you're managing them directly rather than unmanaging them. I think a really, an easy example is think back to 2022, obviously 2022, 2023, much of 2024, a really rough ride for bond investors because even for corporate bond investors, think about the Bloomberg Barclay aggregate index, of the corporate bond index, right? Well, that has a duration of about 8, 9 years. And so you're getting compensated for both a positively sloped interest rate curve and for the credit risk that you're accepting for investing in corporate bonds, right? Well, that's nice most of the time because most of the time the interest rate curve is positive and the credit yield is positive, right? But for 22, 23, and much of 2024, the interest rate curve was negative. right? So if you own a basket of corporate bonds, then if you also own a carry strategy, what you have is um, in the bond portfolio, you're long credit risk and you're long duration. In the carry strategy, you're short duration, right? Why? Because you've actually got a negatively sloping interest rate curve, and so you're you've got negative carry on this duration debt, right? So in that way, you're sort of partially offsetting much of this negative carry exposure that you have in your normal portfolio by investing in this diversified carry strategy, because it's just reducing the negative carry on the duration element of your corporate bond portfolio. There's obviously hedge funds that offer carry strategies. You can get a carry strategy if you're an institution, you want to sign an ISDA with a bank and get access to the QIS strategies. Other than that, you're kind of out of luck. At the moment, investors are making decisions that are not really guided by their short-term economic self-interest, but rather are guided by other motivations, either geopolitics or what have you. Um, and what that means is that in some cases, the markets have become quite dislocated from their economic equilibrium. And we like to think of that as potential energy in the portfolio, right? Like the investors in the carry strategy over the last year have spent a lot of energy rolling the boulder up the hill, right? And at some point, then the conditions will change and that boulder will roll back down the hill. Historically, we see that after periods of like, a year or two of struggle, that the carry strategies do go on to produce some of their best returns over the near term, right? So, it could be quite a prospective time to start allocating to carry strategies. It may not look as attractive over the last year or so if you look at the chart, but that's, carry is one of these strategies that can build this potential energy. It's just like a value portfolio. When it goes down, the companies in it just get cheaper and more attractive, right? Well, carry has this same kind of quality to it. And in many ways, the carry portfolio of today is more attractive with potentially higher expected returns over the next year or two because of it than when we launched a year or so ago. So just something for investors to think about. We can judge that by historical simulations, but which have been very strong. But in general, I think it's healthy from an expectation standpoint for investors to kind of think about these diversifiers as having the same approximate long-term expected return per unit of risk as equities or bonds or other types of risk premia or strategies that they might think about allocating to, right? So the long-term excess risk adjusted return for global equities is in the neighborhood of 0.35 to zero point 0.4. It's about the same for bonds. I think we could probably say the same thing for a managed futures trend or a managed futures carry or a merger arbitrage strategy, which are some of the other strategies that we are stacking. But so we run the carry strategy at about a 10% volatility. So we might expect a 3 to 5% excess return over the long term from an allocation to carry, just as we would expect similar returns at that same volatility for an allocation, a stack to trend or a stack to merger arbitrage. So an extra 0.3 to 0.5% a year on average long term at a 10% allocation. The track record on stock picking is not very good, right? If you look at the SPIVA annual reports, typically somewhere between 70 and 95% of active managers underperform. And the managers that have outperformed over the past 1, 3, 5, and 10 years actually typically go on to underperform over the next 3 to 5 years. So it's just very difficult to find active managers like that are stock pickers or bond pickers that have a high likelihood of outperforming. So, these are just uncorrelated strategies that are, in the macro space, they're not nearly as picked over. I like to say 99% of all cognitive and computational resources in markets go towards choosing the best stocks or choosing the best bonds. And there's almost no effort or resources allocated to, how much uh, WTI crude oil should I own relative to Brent crude oil, or uh, German bonds, or U.S. equities, or the U.S. equities versus the Nikkei. So this is just not nearly as picked over. There used to be a rule called Samuelson's law that says that the market is micro efficient but macro inefficient. Micro being, picking stocks within the stock market. Macro being picking which stock market, which bond market to own, or whether how much to own in stocks or bonds or commodities or gold or currencies, etc. Right. So we believe that this is a much less efficient space to seek these excess returns in. Like, the returns are likely to be stronger over time for each unit of risk and more sustainable, just because there are regulatory and institutional frictions to the deployment of a massive amount of capital there. So we think it's a really good opportunity for retail investors. It has very low average long-term correlation to the types of things that retail investors typically invest in, and it's just not offered um, anywhere else to retail investors in this form. And the structure of being able to get access to this diversification without having to give up the core stock and bond exposure that people have grown to really love, I think is the gift that keeps on giving. The primary educational portal for return stacking is returnstacked.com. That's stacked.com. There's also returnstackedetfs.com. And there's plenty of research on managed futures, diversification, and carry itself, including a white paper and a long, detailed blog post on investorsall.com on our blog. So there's lots of videos on Resolve's YouTube channel, on the Return Stack YouTube channel. So, we're doing our best to try to cover the waterfront in terms of educational material for carry. And if anyone has any questions or follow up, then we would welcome direct questions to me at adam.butler@investresolve.com.